Thank you. So my name is Matthias Knab from Opalesque. We are a niche media company focused on everything alternatives. In preparing this panel, I looked up some data, right? How big is impact investing? One number I found from the Global Impact Investing Network from 2022 is that impact investing isn't a niche little asset class. So that number puts impact investing AUM at 1.16 trillion. And another number puts it at 3 trillion. And it says in the next 10 years, impact investing will grow to 7.78 trillion. Just to put that a bit into perspective, the hedge fund universe is currently at 4.3 trillion, private equity at 4.4 trillion. And so, as Rachel said, it's super, super wide and, of course, super interesting. We have a very diverse panel, different countries, different companies, etc. The last panel we had all had these big super houses, KKR, Apollo, Blackstone. Not everyone is familiar with your firms, except maybe JP Morgan Private Bank. So maybe let's start with all of you give us a brief 1-minute CV and also explain what is your link to the theme to impact investing. Let's start with this side, Henry.
Yeah, so name is Henry Makansi. I'm a co-founder and partner of a investment firm based in New York called Kimmeridge. We invest public, private, across the energy spectrum, so not just impact. I run the impact, we call it Kimmeridge Carbon Solutions side of the business, invest in renewables, companies that service the renewable industry and anything sustainable.
Great, thank you.
Great, thank you. I'm Sylvia Solomon. I'm from Kimura Capital. We are a trade finance specialist, an alternative investment fund manager, and what we have really been increasingly doing is really funding the energy transition and also sustainable agriculture as well. I wear another hat because of the size of the impact investing portfolios and the growth there. We've realized that we need to actually create a separate platform for our African strategy. So for that, I'm the Chief Investment Officer there as well. Thank you.
Great. So I'm Gresham House. Gresham House is a specialist asset manager. We really focus around the sustainability thematics. I run our sustainable infrastructure division, and what that means is we're trying to invest into profitable, real asset-based solutions for the big environmental and social problems, everything from vertical farming to habitat banks, which is a new asset class we created to support regeneration or nature-based solutions, through to adding 31 children's nurseries to the UK. So trying to find environmental and social impact angles into this from a real asset-based perspective.
Fantastic. My name is Larry Abele. I'm the founder of Impact Cubed. We're a group of 44 people based in London, ex-hedge fund managers, long-only managers, and we act as investment advisory to mostly asset owners and private banks on how to bring some of these issues around social and environmental externalities into their portfolio in an efficient way.
I'm Carlotta Saporito. I'm the head of impact investing at JP Morgan Private Bank. Impact investing for us means it's in private markets. So we allocate capital really across the spectrum of the SDGs under the 3 themes of climate solutions, inclusive growth, and health and wellness, with inclusive growth really meaning financial inclusion and education, both through discretionary strategies. I'm the portfolio manager of a couple of those, and also through traditional private bank channels.
Okay, let's dive into the theme right with you, Carlotta. So at JP Morgan Private Bank, what themes within impact investing do you prioritize right now? What's hot? What are you looking at?
Yeah, so within the 3 themes that we have that I just mentioned, I think we are agnostic with respect to how much of our portfolio goes to each one of these on an annual basis. We are very much guided by the quality of the pipeline. So obviously, unsurprisingly, we're seeing a lot of very good deal flow in the climate space today, both in our indirect strategies and also in our co-investments. I think that, the reason why we do that, the reason why we're pipeline guided is that, and probably I can make a little parenthesis here around what we think of as impact, which is We apply the same investment lens and due diligence discipline that we apply to any of our strategies for the simple reason that we think that the extent, the scale of the capital that is needed to address some of the opportunities that we have today, some of the challenges and the opportunities that we have today are in the trillions. And so in order to mobilize trillions, which we think is primarily a private markets opportunity, you need to make the capital allocation decision as simple as possible. How do you do that is by generating returns that are at least as attractive as any other strategy on our platform. So for us, impact investing is investing, and then if something makes it through our commercial screen, then we will evaluate it as an impact strategy, but then and only then.
Anyone wants to add? What's hot for you? What do you see? Which opportunities in impact investing excite you?
Well, we've seen, during COVID, there was this realization, suddenly climate and sustainability became this hot area, certainly in the public markets, where you saw huge numbers of SPAC IPOs, venture and growth capital going into climate and sustainable companies. Many of them, no cash flow, no proven business model. A lot of them went public. And that bubble is kind of burst now. Energy transition stocks, a lot of them were things like electric scooters and so on. Stocks are down 30% year to date. They're down, in some cases, 75, 80% since the peak. And when we look at opportunities on the private side, there are really two buckets. There's the infrastructure side of the business, which is large equity checks and project finance. And in the case of the US, heavily subsidized, Oliver Blanchard mentioned this, by tax equity and the IRA. And then you have the venture side, which is companies and growth, which are picks and shovels businesses servicing these large build-outs of assets. And with rates having risen, let's say renewable projects, these large capital projects, first category, are extremely sensitive to interest rates, right? So margins have compressed. In many cases, they aren't able to pass on inflation to their customers. So that's created some distress, certainly a correction and slowdown in a build-out. Venture, same thing. We've seen venture corrections across all sectors, not just climate tech. And so a lot of down rounds, but I think, an interesting time to invest, frankly, if you're prepared to lean in and be countercyclical.
Right. So who else? Opportunities, what excites you in impact land these days? Well, Larry?
Sure. We focus on the public markets. We're mostly advising pensions, endowments, and the biggest pool they have is in the public markets. I think there's been a lot of attention on carbon and obviously a global phenomenon. Obviously, we're all experiencing it. But we're seeing a lot more interesting things happening in water. I have a joke that carbon kills you in 30 years and water kills you in 3 days. And water is a very local issue, so it's very different than carbon in the sense that you need to know exactly where the firm's operating and where they're accessing their water. Now, with things like satellite technology and things like this nowadays, we can practically look into the water reservoirs that are near corporates that are using a lot of water and see if they're going to have competition with their local farmers, for instance. So it's kind of getting in front of potential issues, whether it be alpha-driven or some of our clients are simply, listen, it's not an alpha move here. We just got to align with our stakeholders who are demanding less fossil fuel in our portfolio. So then it's simply, how can we do that for the least tracking error possible? So we have clients coming to us for value alignment, risk reduction, and pure alpha seeking. But they're all looking at those same issues, which, environmental and social externalities impacting their public equities or their fixed income.
Peter?
Yeah, look, I think Carlotta and I were talking about this earlier as well. I think we're now at this tipping point also where assets that are impactful can actually have more attractive financial returns. I think we're just at the point now, because in the past, if you sat up here being an impact fund, it's almost like a dirty word. People are saying, well, you've got to give up returns. That's not the case anymore. And if anything, there's a lot of examples I can give, but basically we think that impact can really drive financial returns, and I think that hopefully then is a tipping point, because ultimately, even if we're 1.5 or 3 trillion, that's a drop in the ocean compared to what we need to actually affect the change that we need. We need to start to allocate that global corporate public bond market, $180 trillion. That's kind of the scale of impact that we need to affect the environmental and social points that we've all got to tackle that people aren't really doing that because there isn't an easy solution. There isn't a jab to fix climate change. It's a really wicked problem. And I think the sooner that we all understand that actually there's a really, really big market there, there's some really attractive returns as a result of that, then I think hopefully we get enough of the people in this room to start to think actually that's a good place to point your intellectual as well as your financial capital. Because I think that's really the biggest opportunity. Like I've looked at infrastructure for the last 20 years. When I first did an infrastructure asset, it was 20% unlevered IRRs. You'd probably do that at 5 or 6 now. So, there's a big yield compression, and I think you're going to see the same thing in sustainability-focused assets over the next couple of decades.
So when we talk about impact, right, one of the questions that came up very early is how do you measure it, right? How do you actually measure the impact of your investing? So maybe we can touch on that. And then what Peter mentioned, is there still a gap between those traditional ROIs and those social environmental ROIs, or was there never a gap? Where are we with that? So let's talk briefly about measurement, and is there a gap, or has there never been? Who wants to take that? Yeah, Larry?
I'll start with the measurement gap on the carbon markets. In my mind, we're never going to get out of this mess without looking at offsets. There reaches a point in the cost curve of any corporation where the cost of further carbon reduction in your operations is just getting astronomical. You're hitting 500 a ton, 700 a ton, 1,000 a ton. And of course, you're going to look for offsets. It's a natural thing to do. But until the offset markets can build their credibility with getting better measurement and defining their rules and getting away from a lot of the double counting that's going on and the sort of projects that have been in the news for failing, I think we're going to really struggle. So measurement of carbon offsets, I see, is a massive, massive important thing for us to solve.
Can I just quickly state, like, measuring impacts actually isn't that hard, right? So if you've got a vertical farm, you're displacing farmland that uses a lot more water, a lot more land, a lot more chemicals and pesticide. Measure how much you're displacing or avoiding. Like in our vertical farms, we can grow in 4 acres what it takes 1,000 acres to grow in the field. That's a pretty big number, and it's a pretty easy number to measure. And I think more and more, carbon has kind of caused a bit of a problem, call it that, in terms of the way that the impact world is perceived, because there have been, I think, errors or flaws or whatever, probably more extreme words for that, but hasn't done our industry a lot of good. But ultimately, measuring impact is relatively easy, and I think that's what we should just keep focusing back on.
I think it's interesting because, sorry.
Yeah.
Go ahead.
No, that's all right, Claire, if you want to, shall I go? Or?
No, you go.
Yeah, I was just going to say, I mean, actually, I was very happy when you talked about financial returns in impact. And I think that's one of the greatest myths, to think that when you're an impact investor, you shouldn't be thinking about the financial return. Without that new free cash flow, you actually don't have the capability, and you can't scale up any project to actually deliver real return or real value over the long term. And I think actually as investors, we need to go back to actually thinking about what is the investment horizon and who are the stakeholders that are actually collaborating together to actually generate that value. So one, I think, theme that I think is really interesting, and actually I think the impetus has definitely had a bit of a tailwind since COP28, is the idea of blended finance. So when you have blended finance structures, you do actually have different stakeholders who actually have got real opportunities to give leverage to the different investment horizons and the way in which they measure their KPIs. And so financial investors like ourselves, which is what we tend to do, we can focus on the returns. I mean, in trade finance, which is actually at the liquid end of your private equity or private debt market, actually it's actually a rates-based product. So pricing is actually based off SOFR, which is about it's actually going up to 6% at the moment. So we can easily generate returns that are, up to between 10, 12, even 14% on a sustained basis. And that's actually real returns. So you actually get an inflation hedge with a product, but at the same time, you'll also be able to direct the actual cash flow to the part of the segment that actually needs it. So when you were talking, I think, earlier about the disruptions as well with regards to supply chains. driven not necessarily just by post-COVID, but also with the conflict in Ukraine. In Africa, there are new bilateral trade routes, the same in Asia, the same in the Middle East. These all need financing. And I think actually in terms of impact, think about your asset class. You don't actually need to reinvent the wheel. You can actually just really be very focused in the same way we're hyper-creative. We just need to be hyper-judicious in our execution.
No, the only thing I was going to add is that sometimes you get lost in the weeds almost when you look too much into, are we measuring impact properly? Because, I think as an analytical mind, the first thing you want to do is to put a number on it and to be able to compare that number across everything, the same way we do with investment returns. And I think that is sometimes where you get lost in actually what really matters is, in terms of what do you define as impact, is if we accept that, call it the SDG because it's just simple common language, do we agree that then impact investing is something whose business model allows you to move towards a reduction in the gap to reaching that SDG? And because I think in the case of carbon, it's probably the easier thing to measure. There is a number that you can associate with it. But in everything else, it's extremely difficult to come up, even within two different portfolio companies, of how you do that. So for me, kind of that's how we look at it.
I want you to prepare for questions, right? So we don't do questions just the last 2 minutes, right? If you have a question already now, raise your arm, or I'll give you another. Yes, there's a question. There's a microphone coming soon.
It's been my experience that positively impacting is sometimes a matter of opinion. So I'm wondering, in the energy space, whether you would consider positive impact from uranium, for example, or uranium mining.
Well, that's an interesting one. There's Musk has come out and said that we need to reinvest in nuclear. I think Microsoft has hired a nuclear engineer and Amazon. And if you look at the rate at which data centers are being built, I think Microsoft is building a data center every 3 days or so. And the amount of compute required for AI, just the energy consumption is staggering. And so when you build a data center today, you'll go to the big four and you'll try to rent out your space, and they all want clean electrons powering that. But the reality is it's still largely natural gas powered. So nuclear would be the obvious, and uranium had a recent spike. Would be the obvious one. Obviously from a private investor point of view, the length of my fund is shorter than it takes to permit a new nuke, and the few ones that have been built have been so over budget and over time that we see like smaller concepts, modular nukes, 40 megawatt type nukes, but even getting those approved in the US at least, you've got to go through federal government, and it's a multi-decade probably process to get them approved, but it would obviously solve a lot of issues.
Great, thank you. More questions? Yes, over there.
As countries launch biodiversity markets, what lessons do you think we can learn from the failure or otherwise of carbon markets?
I'll take that. So we've got a business called the Environment Bank, where actually we are creating habitat banks to meet the UK government's Environment Act. I think the thing we can learn is actually that the carbon market kind of went, I call it a race to the bottom. It was like, how low could you go in terms of ecological integrity? What can you do to almost get the cheapest carbon credit? Like if you looked at Ryanair, they were paying like $4 a ton for their CO2. Like that's total bollocks, right? I think what we have got the advantage here of in the UK is that they're starting in a different perspective. It's a compliance market. So firstly, it's legally required, and therefore it puts an actual cost on biodiversity. So if you're a developer, you have to buy a biodiversity net gain unit either on-site or off. And that's a cost. So that puts a value on biodiversity the first time, and therefore I think it puts it into a whole new world where actually you've got a whole bunch of really ethical operators trying to create, I call it a race to the top in terms of ecological integrity. And that's what I hope for. I think We've got a government standard now, it's DEFRA-metric, so it gives you a baseline. And then I think the government will put a policing mechanism in, it'll get policed by the planning authorities. So I think we've got a really good chance of actually creating a blueprint for what we should do globally to try to enhance biodiversity, because we can't do net zero without nature. And that's a bit that I think there's sort of more of this sort of understanding now, and actually I think there's a really, really big impetus to create a new asset class, because that's the compliance market, but there's also a voluntary market. So all of you out there that are corporates that want to do and become nature positive, there's an opportunity for you to buy into really high quality biodiversity net gain habitat banks as well.
Happy with that answer, co-panelists?
I agree with you that having the sort of government regulation in there really provides a great base for it. But let's not lose sight of there will be a lot of greenwashed biodiversity product going into the market in the near future. It's probably the hottest topic we get asked about nowadays. And certainly in the public markets, it's difficult to find sort of a fund that's pro-biodiversity. You can find firms that are sort of avoiding the biodiversity loss of their competitors or thinking about it more. But there's very few firms, we found maybe 1 or 2 small caps in the world, whose goal is actually producing more biodiversity as their business model. That's pretty hard to find.
Yeah, this has to be a greenfield strategy, right? You have to be building new habitat banks to create the biodiversity. You can't just like pretend to be saving some, because there's no additionality, and that's what impact is about.
Great, thank you. Great questions. Yes, please. Microphone is coming.
I want to bring a perspective to this impact, and what I want to share is impact doesn't come from a profit mindset. It's a non-financial outcome. So when we are talking about measuring impact, probably you might agree that we have to step back and first think about what is the purpose, and is there a purpose at a higher level? And then the impacts, if are towards the purpose, they would align with 1 or more SDGs automatically. And then we can create a measurement mechanism by putting up a pathway, what is that for each of the SDGs the entities need to achieve. And if they achieve their targets, then they become 100%. So based on that and relativity across SDGs, we can actually create a mechanism in which we can measure entities' sustainability performance. And if we can create standardization in this approach, then that becomes comparable. So it is about a systemic change at the entity level that we need to bring, right from purpose to this measurement mechanism, to help us bring and solve this conundrum of impact and sustainability performance, to be really create that asset class where we can think of flowing the funds at scale. Right. I don't know if I am asking a question or
so the question is, how far are we with that systemic change, right, that she's talking about, that we need? How far are we? Larry?
I mean, we spent the last 7 years trying to model that impact dimension, as you say, separate from the financial dimension. And so we've taken the typical risk-return efficient frontier and made it 3-dimensional. But what we find is you can have an investment that scores really well on the impact dimension, like you say, but not doing so well on the financial dimension. And then our customers are saying, well, I'm not really interested in that investment. I'm interested in the Venn diagram of lots of impact and financial reward. We're not finding very many who will take that, whatever quadrant you want to call it, that bottom right quadrant of lots of impact, but not much return.
Yeah.
And we did
I was just going to answer as well. It's an interesting perspective, and I appreciate sort of your comments with regards to return and impact. But at the end of the day, there is a cost of implementation. Yeah. There is a cost to climate technologies. There are different costs that still have to be embedded, and it could be that you're thinking about the short term. I think going back to the investment horizon, how short or how long is the duration of the observation period of engagement with regards to the impact? So I'm just saying it's a bit of both. So that's why, sorry, in terms of the quadrants, that's actually quite important as a factor.
And I think that there is a space in the ecosystem for all of those considerations, right? I spent a good part of my career in development finance, where I think you can take different views on that, right? There is blended finance, there is also, but even in the non-DFI world, there is venture philanthropy, there is philanthropy, there is like various forms of capital that you can deploy to achieve different objectives. Ultimately, for me, the key point is, are you adding value, are you detracting value, which is your point to the cost, right? If you do not take into account the cost of delivering something, then you're not making something sustainable. In order for it to be sustainable and to attract capital at the scale we need, it needs to be comparable with other capital allocation options.
But But wouldn't the amount of capital that comes into this impact world actually be multiplied by an X factor if we actually properly applied the cost of all of the other production methods on this planet? Like if everyone else's externalities were properly taxed or factored, imagine what the direction of capital would go in that case.
Well, I think that's you put your finger on it, right? Carbon is easy because at least there is a price. There might be a wide range, $4 to $800. But other social impacts don't have a price, right? So you don't know how much they're going to.
They have a price.
Well, they have a price, but they don't have a listed price.
We're working with a customer who's going to issue an ISIN for a bond that's purely discretionary. So it's going to fund de-escalation of war in conflict areas.
Wow.
So you're going to buy an ISIN, buy a bond, and you're going to know you won't be paid back. Your payment back will be these de-escalations of war in frontier markets.
So, as we see, there's innovation going on in all parts of the impact industry, impact investing industry. It's very important for all of us. Thank you all for staying. Thank you for helping me. Thank our esteemed panelists. We are at the end of this session. Thank you very much. And